Valutrades, forex CFDs and commodities.
Excellent. Good evening, everybody. It's Paul Wallace here. We're here on Wednesday, 26th of April, and tonight we're delivering another one of the Valutrades exclusive webinar. And this evening we're going to be looking at how to avoid the Trump bias and also a little bit of live market analysis. As you'll know, the markets have been rather entertaining, shall we say, for the last few weeks, and so there'll be plenty for us to look at and plenty for us to discuss. But as always, before we begin our presentation, we'll just start with a quick risk disclaimer. Hopefully you can still see the slides all working well there, but you should be aware that CFDs and FX are leverage products and carry a high level of risk to your capital. It is possible to lose more than your initial deposit, and you may be required to make further payments. These products may not be suitable for all clients, so please ensure you fully understand the risks involved. So, avoiding the Trump bias and some live market analysis. Well, first we're going to have to explain maybe to some of you what actually is the Trump bias. What actually is it that we've been experiencing? Then I'm going to talk a little bit about an introduction to cognitive bias in general. Some of you here watching this may be aware of that. So for some of you, it may be completely and utterly new concept, but hopefully by the end of our slide session, you'll be a little bit more educated about what they are and actually how they can impact us as traders. I'll also talk about a couple of very simple ideas that you can use to overcome certain bias. As said, after that, we'll switch across to do some live market analysis. There's plenty for us to talk about, even with just our comments today. And of course, we have an interesting day tomorrow with Draghi speaking, and I'll run towards the next French election and British election over the next sort of 2 to 6 weeks. As always, I'll quite happily take any questions you may have. If you just want to ping them across into the chat box, I'll answer them either as we go or at the end of certain sections to ensure that we have a good flow for the session. So, avoiding the Trump bias. Well, I'm sure I don't need to tell any of you that Donald Trump won the US election back in November, which, we were already looking at it being 6-7 months ago. And invariably, he has provided us with an interesting journey over the last 18 months, shall we say. But I suppose part of the thing that's of interest is that prior to his victory in that election, the MSM, which is often what's used to describe the mainstream media, were very, let's say, vehemently claiming that that he would not win the election, or that B, if he did win the election, he would destroy the economy or the markets if he did. Which was a very, very similar, let's say, message that was handed out regarding Brexit. It was a rather very negative message. It was a rather derogatory message, and one that was driven by fear, which is something we're going to come back to in a little bit in a moment. But the truth is that so far, and I do hasten to add so far, on both those claims that the mainstream media were absolutely wrong. And if we just look here at the sort of the chart of the Dow Jones 30, I've just sort of put in a chart there. We can see that despite all of the commentary that the American markets would collapse, that should Trump be elected, most of you will have already seen that this is a weekly chart, a weekly candlesticks. You can see that hopefully you can see the clear week when Trump was elected, because we had an immensely strong bullish week which closed above recent highs, and then invariably we've been on rather a fantastic sort of rip bullish rip over the last few months, and I'm sure it's not missed any of your attention that that has provided some fantastic opportunities. And I've just put up a chart there of the Dow Jones weekly there, but if you look at any of the major American indices, they've actually sort of acted in the same way. If you look at some of the major European indices and global indices, you'll see that it's had a similar impact as well. His election, regardless of an individual's politics or regardless of whether you love or loathe him, has produced trading opportunities, and ultimately that's what we are. We're traders. We're looking for great opportunities, and as I said, whether you love him or loathe him from a political standpoint, you can't disagree that he has provided us with some wonderful trading opportunities. But the problem we've had, for some traders is that when you're constantly bombarded by that media bias, that media negativity, it's hard for it not to influence our own particular decision making, and of course, as it does influence our decision making, then that's effectively going to have an impact upon our own trading. Most people, and I actually include myself in this thought that the initial reaction to Trump's election would be a move down in the markets, and I held my hands up there and thought that would be the initial reaction. It's sort of a knee-jerk reaction because the whole world thought they were going to get one result, and effectively they got another. But as you can see, as we can just see from that chart that just passed, that invariably, there was a huge, effectively, a huge wedge of funds, cash, call it what you will, flowed into the market. And we've been running at full steam ahead since then. So as I said, this media bias can sometimes affect us as traders, and so it's an opportunity for us to start to learn about, how do these biases actually affect us? Is there anything we can do about it? And that's what leads us on to the main part of our particular session for this evening. So what we're going to talk about is, in terms of that Trump bias, because invariably we're going to have, opportunities for the remainder of the year during the French election, the British election, the German election, the Italian election, and other news announcements that will come through on our rather entertaining lifestyle that we lead these days. Is that what I want you to understand is that as human beings, we all suffer from fear, greed, hope, and cognitive biases. Now, as I said, some of you will have never heard that term before. Some of you may well be aware of it from reading books like Thinking Fast and Slow, or from reading or seeing sort of particular educational pieces on cognitive biases. But what I'm going to do is I'm going to talk a little bit about fear and greed and their impact, and also how cognitive biases can actually play out and impact us. Those of you who will know cognitive biases will know that there are simply dozens and dozens of different biases and heuristics. But what I'm going to do is just focus on 3 or 4 of the main ones and how they impact traders. So hopefully by me raising your awareness, you'll be in a position to make better choices, and invariably when we make better choices, we increase the probability of a better outcome. But that's a thing we're going to touch upon in a few slides' time. So I'd like you to just to sit and think for a moment, in terms of an introduction to cognitive biases. I want you to think about your own trading experiences. So if you think back, about your own trades that you've taken, who in the group has never been afraid to enter a big trade for fear of taking a large loss? Or alternatively, who hasn't held on to a position just a bit too long in the hope that you're being greedy for more profit, wanting to actually increase your P&L from that winning trade? And who can honestly say that they have always exited a losing trade at the earliest opportunity and never waited just another few seconds to see if it will turn around? I suspect I can speak for most people when I can say that most of us will have experienced at least one of those elements, if not all three of them, in our own particular trading careers. We'll have all experienced them in one form or another, and maybe you've given that some thought in the past. Maybe you just didn't really give any realization to it whatsoever. But I can assure you what's happened is that some of that decision making that you've made, or that you think you've made, was due to the cognitive biases playing out within you. And so it's my time to start to educate you a little bit about this so that you can understand what you're experiencing when you sit down to trade. So, when you actually speak or hear, most trading books, educators or coaches will tell you that fear and greed are to be experienced by a trader, and that actually what you need to do is you just need to banish fear and greed and leave it at that. Is that simply that you can just put them up in a little box, put them away somewhere, and never experience them. And as I said, put up there on the slide, it's a little bit like telling a smoker that the way to give up smoking is to learn to stop putting cigarettes in your mouth. The truth is, if only it was that simple. Many oftentimes we actually know what we should be doing, but we don't actually do it. We don't follow through on it, or we self-sabotage our behavior. And it's kind of interesting to understand, why do we do that? What is it that causes us to know at one level what we should do, but actually to act in a completely different way when the time presents it, or time or moment presents itself. And that's what we're going to start to have a little look at here, ladies and gentlemen. The reality is, fear and greed are within us for good reason. They're never going to leave us, and we need to learn to recognize them, understand them, and try to subvert them so that they work for us rather than against us. So if you ever find yourself, in a room with other traders, or if you find yourself listening or reading to other traders and they're talking about how you can banish fear and greed once and for all, the reality is you can't. Okay, we're human beings. We're actually we're a big bag of chemicals, and it's those emotions, all right, that drive us. And invariably, fear and greed are within us, and as I say, they're within us for a good reason. And it's about being able to learn to live with it and to manage them, and to actually, in some respects, channel those emotions, amongst other things, to help us deliver good performance as a trader. So when you're looking at let's say, aggressive intraday trading, if you haven't already worked it out, your brain is trying to sabotage your trade execution. As I said a little bit before, knowing what to do is one thing, but having the mental discipline to do it is quite another. Some people find that very easy. Some people find that very challenging. And it's actually about learning and understanding that. That is what's going to actually help us make the leap towards improving our own trading abilities. So what it becomes about is, it becomes about having the mental fortitude to take a loss without hesitation. Or it becomes about ignoring those nagging doubts that plague us from time to time, and to enter trades fearlessly. To sometimes keep going when the chips are down, when it feels like the market is against you. What it becomes about for traders is, it all becomes about that inner game that separates the winners from the losers in this particular endeavor. You'll hear people call it by different words or different terms. Some might call it mental toughness, some might call it resilience, some might call it just, trading performance. Some might call it inner game. I think you all understand what I'm talking about. It's about, when you are a trader, when you see a trader going against you, the ability to take that loss without hesitating. It's about being able to see the trade set up and actually pull the trigger on that trade fearlessly. And it's about realizing that occasionally you will have challenging days or challenging trades, and it's about being able to demonstrate the resilience and the self-belief to be able to come back and live to fight another day. So For us to be able to do that, let's have a little bit of a deeper look at who we are, all right? Let's have a little look at the hidden side of you. So here's a question for you all as you listen to this. Would you say that you're in control of your actions? Would you say that your decisions are well thought out and are based on logic and reason? Or do you believe that you sleepwalk through life? You're operating on autopilot, daydreaming about dinner or what's on TV or something else? Just take a little moment to think about that. Maybe you already know the answer to it. Maybe you've never considered it. Well, according to research, up to 90% of what happens in our brains happens on a subconscious level. So think about that. 90% of all our thinking, decision-making, and action happens without us being aware of it. I just want you to take a moment to think about that. Think about the impact that could have upon your trading. Think about, your behavior, every day, not just in trading, but every day in everything you do. If 90% of all your thinking, decision-making, and action happen without you being aware of it, just think about the implications of that. Take a moment to consider. So, if most of your thinking and decision making is happening at a deeper subconscious level, the reality is that you are at war. And the thing is, you're at war with yourself. You might not know it, but there's a fight raging inside your head right now. And it's a civil conflict between different regions of your brain. And all of this comes back from our time as cavemen. We like to think that we are cultured, smart, urbane, civilized individuals. But actually, when you scratch the surface and dig a little deeper, you'll realize we've not come too far from our caveman origins. And part of those caveman origins are still playing out with us even today in a world of jumbo jets, smartphones, internet connection, and electronic trading. We still sometimes operate like that caveman. What I can tell you for certain is that part of your brain is telling you to pay attention to this presentation because of all the benefits that go with it, from listening to Paul talk about what you can learn and how to become a better trader. But what I'll also know is that another part of your brain is competing with this message. It's telling you to go out and eat. It's telling you to procreate. It's telling you to go out and acquire supplies. It's telling you to go out and remove your enemies. That's the definite caveman side of you. But then there's another part of your brain. We're going to call this the lazy part, that's telling you to go and switch on the telly, put your feet up, play a game, or go to sleep. It's telling you to do anything that will let it shut down and avoid working. Why is it doing that? Because it wants to conserve energy. When you were a caveman, and when food and resources were hard to come by, it was important to conserve your energy. And 30,000 years later, that part of our brain still ticks away. But what I just want you to really understand is that, as in any war, each side thinking it's fighting for the cause of righteousness. And in a way, they're partly correct. The needs that you have as a human being, the many parts of your brain are trying to fulfill, they're actually all very basic. It's all concerned with making sure that you, or a direct derivative of you, continue to walk the earth. Anytime you decide to do something that conflicts with these basic survival needs, your brain is going to fight you. Some of you may have heard of Maslow's hierarchy of needs, and there's a little sort of slide there, or a shot of it there, which you can understand. But what you learn is that at those most basic needs, humans need safety, security, food, water, warmth, rest, physiological and safety needs. And what will happen is that if your brain does not think that you're getting them, then it will do anything to achieve those, even if those things are counterproductive or damaging. So deeply ingrained is that need for shelter, for water, for food, for comfort, for social interaction. So deep is that need that we will do whatever it takes to achieve that, even if what we do is damaging for us. So just think about that, because we're going to come back to that in a couple of moments. So I'm sure you're all aware of fear in trading. And the reality is fear is our #1 driver for survival. It's a primal emotion that resides deep in the amygdala, the oldest part of the brain. Fear is so successful at ensuring the continued existence of life that it has survived every step of evolution. Think about that. Fear is so deeply embedded within us that we can never hope to eliminate it. Instead, we must learn to control it, or better yet, use it. Think about it. When we were cavemen on the savannas, the plains of Africa, where we were surrounded by, lions and tigers and boars and all manner of dangerous animals, fear was one of the things that kept us alive. And that's actually still to this day is our #1 driver for survival. You will never, ever not experience fear in your life. I'll say that again. You will never, ever not experience fear in your life, regardless of whether you're trading or not. Fear is so deeply embedded within us, you can never hope to eliminate it. It's about learning and understanding the different types of fear and how they may impact you and therefore your trading. The reality is for traders is that almost all of the problems we encounter in our trading are born out of fear. Even greed is a response to that emotion. Greed is simply the fear of missing out. Greed can be traced back through our evolution as well. And in the modern society, there should be more than enough to go around. And yet that greed response is so deeply etched into our amygdala that we experience it. If you think about it, when we were cavemen, as I said, and we were short of resources, what would happen is that, we would be greedy. We would go out and try and, grab as many resources as we can. However, in the modern society, for most of us, certainly in Western civilization, we have water to hand, we have food to hand, we have shelter to hand, we have warmth, okay? We have a connection with other human beings. We have all of these, and yet, we still find that greed switch gets triggered because it's so deeply ingrained in us that we want more. So fear is the engine that drives our subconscious. Humans have developed a number of higher level behaviors that whir away in the background, informing our choices and nudging our decisions in a certain direction. Most of the time, we're blissfully unaware of them. We may not even really realize they exist at all. These behaviors are what's called cognitive biases. These are, think of it like software that is just whirring away in the background, running the computer, that you think you are making, you're making conscious decisions, but actually so much of it is being run on, let's say, that background software that was programmed 30,000 years ago and by elements of your childhood, and that will help you operate and move and make decisions. And all of these things are linked to cognitive biases. Truth is, as I said, you can't switch off that fear engine, but you can subvert it via these higher level biases. But first you need to know what they are and what they are trying to do. And once you understand them, then you might have a little aha moment when you recognize when you do it to yourself, and maybe have a little think about how you can actually change or break them. So here's one of the first ones, loss aversion. You may have heard of this. You may have heard of this in different terms. But think about it like this. If fear is the engine of our subconscious, then loss aversion is the sat-nav. Loss aversion steers our actions, calling on the power of our fear to protect our assets. Loss aversion can actually play havoc with our trading performance. If you're a fear-based trader, it discourages you from taking risks that are inherent in your trading. But for greed-based traders, it can drive impulsive trading and a reluctance to crystallize a loss. So what does that mean? Well, if we will do anything to avert a loss, if you're a greed-based trader, what that might mean is that you have very, very poor risk management principles. That you're engaged in impulsive trading without any sort of form of risk management, and that invariably means that you can feel the pain of a loss, or not, because that's what we're trying to avoid. Similarly, for fear-based traders, what it actually means is that we are so desperate to avoid a loss that we actually don't even pull the trigger on a trade. Here's an interesting little bit of a statistic, because the challenge we traders have is that we feel the pain of loss 1.8 times more than the pleasure of gain. So let's just round that up and say, call it roughly 2, okay? So think about that. We feel the pain of loss 2 times more than we feel the pleasure of gain. So when it comes to trading, this is why we see traders drive themselves towards high hit rate trading methods. We don't want to be wrong. Why do we not want to be wrong? Because we feel the pain of loss twice what we feel the pleasure of gain. So people want trading methods that have a 90, 95, 97, 98% hit rate, because we will do anything to avoid a loss. Humans are very, very sophisticated at being able to do whatever it's required to avoid pain and to avoid the pain of loss. This loss aversion bias will run through every element of your life. Even I know I have it. We all have it. It's about being able to be aware of it and start to recognize it when we see it in our trading. Fear, greed, and loss aversion are perhaps the 3 most prevalent emotions and biases that we experience as traders. They are hard to change as they are deeply embedded, and they affect everyone, not just traders. I guarantee that everybody in your life will be experiencing fear, greed, and loss aversion in one form or another. What we need to do is start to look to subvert their power rather than fighting them. Trying to fight fear, greed, and loss aversion, it just is not a very smart way to do. Not a very smart way to operate. What we need to do is to understand it and then look to subvert their power rather than fighting it. So let's have a look at some more particular trader biases that we see. The first one I want to talk about, optimism bias. Well, as the name implies, it's about being optimistic. So think about this. The sheer number of insurmountable problems in the world means that individually we could never hope to overcome them all. You switch on your TV, okay? You log onto the internet. You can see it for yourself. You can see all of the problems in the world. In fact, you're inundated with all of the problems in the world. And if we spent all our lives dwelling on all of them, well, the reality is we'd never get anything done, because we'd just be so overwhelmed by everything that's happening. So what happens is we don't think about them at all. We actually have these biases that filter that input from our senses. Think about that. We have an inbuilt optimism bias that works to intercept information that we don't want to know about, or that doesn't match our worldview, and then it discards it before it even reaches our conscious mind. Just think about that, okay? We don't want to hear bad news. We don't want to hear anything that could be wrong. So what we do, okay, is we have an optimism bias, all right? So we actually cut out that information before it even reaches us. Furthermore, what happens is we tend to put more weighting towards positive information, which is deemed beneficial to us, and to reject negative information. So as a non-trading example, newlyweds consistently predict their marriages will last their lifetime. Even when they are shown the divorce statistics imply that it's unlikely to happen. Even the pessimists amongst us are deep down irrationally optimistic. So when there are battles or war, one of the reasons they have young soldiers, okay, who go to fight those wars is because they are all experiencing an element of optimism bias. Even though the sort of the likelihood is that they may be killed or injured, their optimism bias is so deeply ingrained within them, they think, well, it won't happen to me. Even though they know the statistics, they know it'll happen to the other guy. It won't happen to me. That optimism bias just runs through everything we see and do in our lives. For traders, we rely on charts and data to base our trading decisions for most of us as private traders. We have to interpret raw information. But if our subconscious mind is filtering out anything that doesn't match what we want to see, if it's rejecting bad news, then we're not getting the full picture. And we're actually end up making choices based on partial facts. Our built-in optimism means we have a tendency to see what we'd like to see rather than what's really there. Think about that. Maybe you've taken trades in the past and the trade hasn't worked out, and when you had a look at the chart afterwards, you could see that there were actually some warning signs either telling you not to take that trade or to get out of that trade, but you simply just didn't see them at the time. You just simply didn't see them. Why was that? Well, that was because that was optimism bias, all right? That optimism bias just cutting out information. So how do we experience that as traders? Well, very often we experience it as people overestimating their ability. People think they're going to be a superstar trader in 2 days. Sadly, it doesn't work like that. We experience optimism bias as underestimating risk or pain. I just touched upon how we can experience optimism bias as not accepting warning signs or not even seeing warning signs. Or perhaps we're overestimating targets. We're not exiting when we should because greed then comes into play and we think that trade will go further for us. That is all reasons or experiences we have as traders when we see how optimism bias impacts us. On the other side of that coin, we have something called confirmation bias, the tendency to overvalue data that supports a pre-existing belief. So here with confirmation bias, instead of blocking out data that's detrimental to us, confirmation bias seeks out the positive and boosts it, presenting it to our conscious mind as a front page news flash. It shouts, "You were right, you were right, you were right," in no uncertain terms. The truth is, everyone loves to be right, especially traders. We love to be right, okay, and we love to make money. It's the long and the short of it. So think about that, okay? Confirmation bias is when you have made a decision that you want to be a buyer of euro dollar, you know, you're in a position, what will happen is you will look for any information that will confirm that you made the right decision. Even though the trade may be turning around, you will focus on that one little piece of information that just confirms to you that you did the right thing. So here's a specific trader's example. So, you know, you get a new trading strategy which you try out. You take 10 trades, of which it turns out 8 are losing trades and 2 are winners. Subconsciously, what you will do is you will bury the losers. Then you'll take the 2 profitable trades that you take to heart, and what happens is that boosts our faith, even though the bigger picture says otherwise. So from a personal trading understanding of seeing traders over the last 10 years, is that lots of new traders love to try and pick tops and bottoms in markets. They love to try and pick tops and bottoms. And what happens is when they get it right, they'll tell everybody. They'll be telling people on the bus, on the train, they'll be telling people in the pub, they tell everybody, okay, about the fact that they were right and they called the top in the Dow, or they called the bottom in sterling. And that's fantastic, and they live on that. What they didn't tell people was the other 9 times when they were wrong and caught that on the wrong side, because all they want is that they bury the losing data and they focus on the trade that made them look good. Confirmation bias affects us all, I assure you of that. So here's a little hack for a couple of these simple ones. These two biases conspire to upset our best efforts. And how do they do that? Because they hide the truth from us. So what can we do? And here's a very simple tool. If you're looking at a chart and wondering what to do, what you might want to do is to turn the chart upside down. So if you're looking at it on your laptop or on your tablet, turn the chart upside down. And it's incredibly simple yet effective, because what it does is it hijacks our optimism confirmation bias and uses their power for good. By turning the chart upside down, we can confuse the bias. Just try it. When you're looking at a chart and it looks like it's going, we're in an uptrend, it looks like you want to be a buyer, turn the chart around, flip the chart. Would you still want to be a seller of it? What you might find is that actually you're looking at it with fresh eyes and that you're not affected by optimism confirmation bias, and then actually that trade you're looking at actually looks now, sadly, rather woeful. Alternatively, it might just look even better, in which case you know you've got a good trading decision. Here's another one that I see a lot with traders: outcome bias. Outcome bias is our tendency to judge our decisions based on their outcome rather than the quality of the decisions themselves. Traders do this all the time. They judge their success based on the outcome of the trade. So if the trade was profitable, well, they feel great about the world. If the trade was a losing trade, they feel terrible about themselves and the world. What that means is then people start to attach their self-worth to their trades. And what it does is it puts them on an emotional roller coaster. And I assure you, you don't want to be on an emotional roller coaster. We've all entered trades that we knew are substandard. I'm sure if you've kept good records, you'll have taken a trade, you'll look at it, you'll know that they're substandard. Sometimes those trades are profitable just because of random effects, another bias. But because of the aforementioned biases we've talked about, we rate the trade as good rather than poor, which is another bias. So when a trade just works out, even though it might have been a random trade, what happens is we tend to attach our skills to that winning trade. We congratulate ourselves for the good trade. What we should actually be doing is reprimanding ourselves for our poor judgment. That's what we should be doing. You see, if you don't, if you just congratulate yourself for a winning trade and feel on top of the world, the danger is that next time a substandard setup comes along, you'll be much more inclined to take it. The reality is a substandard setup is still a substandard setup. By looking and working on the previous biases, you're looking to diminish the chance or the power of outcome bias. One of the ways you can do that is by actually keeping good records, and within those good records, actually grading your trades, not just for their outcome, but for actually how well you executed your plan. Focus on the quality of decisions rather on the outcome of your trades. Because as any of you will know, if you've traded live markets, once a trade is triggered, anything can happen. And I think we all know anything will happen. So what I did is just give you a little bit of a quick example of some of the cognitive biases out there. But actually what you'll find is there are simply dozens of them. In future sessions, we may look at such things as illusory correlation, apophenia, hyperbolic discounting, irrational escalation. There are even subsets of cognitive biases which sometimes get called heuristics. And they're just simple, efficient rules which people often use to form judgments and decisions. Things like contrast bias, social proof, scarcity, ambiguity effect, anchoring, gambler's fallacy, and the knowledge gap. Some of you, having watched this, will maybe be interested to learn more about that. And if you contact your account representative, they'll be able to sort of give you some hints on where you can read more about these biases and heuristics. Or you can just make a note of a few of these here and go away, and you'll find there's a whole world that you can delve into. What you'll find is that the more you learn about these biases and heuristics, the more you'll realize how they influence not just your trading behavior, but actually your overall life. And you'll see it in others. You'll start to see it in others when they are making decisions based on outcome bias or confirmation bias, or whether they're demonstrating examples of loss aversion in their life, or whether you'll be able to see just pure fear and greed. By actually being able to see it and understand it in yourself and in others, you will also be in a better way to see it within the markets. And ultimately, that's actually what we want to see. So if you've just listened to that and maybe feeling just a little bit overwhelmed at all of this new information that's coming to you, this new rabbit hole that you can go down, you might be thinking, well, Paul, with so many internal and external biases, how can I possibly deliver? How can I trade well? If I can give you some very, very simple advice that you can take away and use for the rest of your trading career, it is quite simply this. Trade what you see, not what you think. Trade what you see, not what you think. Look at the chart and try to work out a process that allows you to identify what that market is doing. Trade what you see, not what you think may happen. Because when you start thinking what may happen, that is when it opens the door for such things as fear, greed, and some of those biases and heuristics to come out and bite you in the backside. Trade what you see, not what you think. Well, I hope you found that interesting, ladies and gentlemen. There's a little bit of insight there into biases. And for the last 15 minutes or so, what I'm going to do is, I'm just going to try and switch across to the charts, and then let's have a little bit of a look at what's been going on. As I said, it's been a pretty eventful year, week, month, quarter so far. So let's have a little quick look. So as I said, if you just bear with me a moment, I'm just going to try and bring up the charts, and we'll have a little talk. We'll have a little talk through there. Okay, so I'm hoping that you can all see my charts, that you can all see the my screens. Okay, there's a euro dollar chart up there. I'm hoping that you can actually all see that. You can all see that there ahead of you. Okay, super. Excellent. Okay, so for those of you who are completely new to trading, what you can see here is I'm just using very simple candlesticks. I have a blue 20 period, a red 50, and a green 200 period moving average, and also drew on fractals and some horizontal levels of support and resistance. So let's have a little talk about the big charts. Well, here we have the euro dollar here. For those who don't know me or have seen before, I actually like to work mostly on sort of weekly charts. So I've got monthly, weekly, and daily charts here that I'm knocking about. So this is the weekly chart of the euro dollar, and if I look out there, realistically, what I've been looking at is that euro dollar's effectively been in a really a range for over 2 years now. All right, between about 104.50 and 114.50. You can see there it's been bouncing around. The start of this year, we had a little bit of a retest of the lows that we saw back in the early 2015 when sort of Draghi came into power and we went for QE. So we saw a little retest of it, but actually what we've seen is a little bit of it's been a bit of a messy grind north, and what we did see, if I just go down to the daily charts here, is that we just let's move this out of the way. Is that actually this is the daily chart? What we did see was that after the result of the first round of the French elections of this weekend, what we saw was almost like a relief rally into the euro and the European indices, and that's why we saw this huge gap here from Friday up till Monday, and we've seen it just hold and consolidate up there around about the 109 level. Okay, the 109 level. So we're above the daily 200 period moving average, which is always an interesting and relevant trading indicator. It's very well used by lots of people, but realistically, if I go back up to the weekly chart, we're still in the sort of the bottom lower half of this particular range. What I'd be looking to see is for us to close above the 50 and the 200 on a weekly basis here. Then you're looking at a bigger picture of are we going to see euro strength and dollar weakness? Certainly the Americans and Donald Trump. To come back to our first slide, he has talked about wanting to see a weaker dollar, mainly because he thinks that will help with with the US economy, because it'll make their exports much cheaper. Furthermore, he's been been quite let's say quite negative about the low rate of the euro, and about how he wants basically the euro to strengthen, and of course the dollar to weaken. So it's we've seen that bump and jump, and actually we've hit highs for this week. We hit highs for 2017, all right, up at that sort of about 109.50. But realistically, I need to see it close and hold above there to give us an indication that we might move back to the 111 area again, all right, or even back up to the 114.50. So keep an eye on that. It makes sense to look at one or two of the other euro pairs whilst I'm here. Here we have the euro against the sterling. This is the weekly chart. So what I've been looking at is realistically, I've been looking at a bit of a scruffy head and shoulders pattern here. Not the sweetest pattern, but we've had almost like two left shoulders, two right shoulders here, and I'm looking at where price to break down sort of beneath that kind of round about, looking around 83. Beneath and hold beneath there, well then I'm looking down and move down to around about 80. Okay, that's 80 and below 80, and then maybe 76. Okay, that's what I'll be looking at. So if you think about that, that would imply euro weakness and sterling strength. Why would that be? Well, we've seen sterling strength come in across the board, and I'm just going to put this on here. This is the weekly chart of the sterling, and let me just show this up. What we can see is we had moves down to around about the 120 level, which is what people were particularly interested in. Okay, 120 has acted as a specific sort of boundary. We then had here. I'm just going to put in what we had here, which is of interest to myself, was that having had a sort of double bottom around 120, we then had a higher low, which was finished off by a nice big bullish engulfing candle, and that was an indication that possible turnaround was occurring. And then what we've seen is we've seen a little bit of move above the 20, hold above the 20, and then we saw last week pop up to to sort of was highs that we saw up there about just over 129. Okay, back up to this particular level, and here we go, particular level there, and that of course was driven by Theresa May's decision to have a snap election. So here we have, this is the daily chart. Price just exploded north. Once again, it's above that sort of 200 period moving average. What would I be looking at? I'd be looking to see whether price comes back to sort of really test that area before heading up beyond the 130 level. That's what I'd be envisaging as a possible trade move. Okay, I actually think we'll see a little bit of sterling strength across the board. We're running towards the election, and I think that most people recognize that that Theresa May has called the election at a very strong time for herself, and in doing so, that will be seen that she'll be effectively a strong leader. She will have done what Gordon Brown didn't do, which was to get the mandate by going to the country. If she's to win and she has a strong win, that will be a good pat on the back for her and for her particular course, the path that she has taken. So we may well see some good elements of strength across sterling. So that would link into that euro sterling breaking 83 and getting south. Also, if we look at this is the pound against the yen on the weekly chart. Okay, it's been a little bit of a sort of it's just been a little bit of a here we go, just like a little sort of move down there. But actually, what we saw was we've seen on the weekly chart, we've seen the ability to get above, all right, above the 50 and the 200. We're now into sort of new territory, and so then you're starting to look at getting back up to about that 148. Okay, 148 price, and that's what I'll be looking to see as an attack on the first instance. Oh, there we go. On the daily, you can see it's been a pretty strong move there. Okay, so what we've seen is sterling strength, Japanese yen weakness, which is kind of what the Japanese want as well. So if we look at Japanese yen, then what we have is this is the dollar against Japanese yen. So this is kind of a bit of an interesting one. This is the weekly chart again. Last year, what we had was you had a break of 118.50. Let's just put it on there. We had a break of 118.50, and price came all the way down to 100. And then invariably we went all the way back up to 118.50-ish around by before the end of the year. 118.50, then we've gone all the way back down to 108 here. Okay, so it's been quite some amazing moves here. So this is the bit like the Dow move in that we saw. This was the start of the Trump. Okay, everyone thought Trump gets into power, and it was strong for both the dollar and strong for the indices, and we saw just a real strong strength in the US dollar. We've topped out, and then we've actually come back down, and this is more like a little bit of a weekly channel that I actually see as operating in it at the moment. I'll just quickly draw that up. There we go. So we're in a bit of a down channel. Okay, it could be said that maybe it's a bull flag and the start of a new uptrend. Well, what would need to happen for that? Well, what that would need to be is an indication of some dollar strength and some yen weakness. And I think that yen weakness might be the thing that we get to see, because that's exactly what the Japanese particularly want. But at the moment, we're kind of just knocking around the 110 level. Just zoom out there, kind of like 110 level there is just, we're just knocking around it. We can see the 200 period daily moving average acting some nice support there, and we've bounced up to the 50 there at about about 111.70. But realistically, that kind of 110 area, that whole zone we're in at the moment is it's like price is coiling up, getting ready to explode out. So we should be ready to sort of trade what we see in that particular case. So let's have a little look at some of the indices as well. All right. So in particular, let's have a look at the let's start with the Dow, because the Dow has been pretty interesting here. Okay. So there we go. Let's just excellent. This is what we have. Okay, so what we have here is the Dow, as I've shown before. We've had just a run up here, and now we're looking like we've had a bit of a bull flag there. Okay, we've had such a strong move there over the last couple of days, mostly driven by that, as I said, that kind of relief rally from the French election not being as bad as people maybe had thought it could be, and we've seen just a bump above that and a move up, right? And it's getting back up towards all-time highs, and realistically, we need to see it break and hold above that to convince us that that's going to carry on, because we've had such a long particular move. If we look at the S&P on a weekly basis, that's doing pretty much the same as well. Okay, the American indices are pretty similar, but as you can see, it's not too far away from that from that all-time high there. Okay, that 2401 high, and that's what we're going to see if it'll happen. Of course, today there's been indications that not only will there'll be tax cuts, okay, tax rates cuts in the US, but also there might be a withdrawal from NAFTA, and I think many people are probably wondering, trying to see what impact that's actually going to have on what impact that will have upon the world. But at the moment, it's still strong for the American indexes. Okay, so once again, as you can see, it's a little bit of a bull flag there that kind of showed up in its particular move. Let's have a look at the DAX. Okay, the DAX, the German index, is kind of interesting. This is on the monthly. What's happened is we got back up to the all-time highs there. All right, okay, just under 12,400, and hopefully you can see that we've actually just jumped through it this week. Okay, there's a real palpable sense of relief in the European markets that Le Pen is not supposed to win, and so with that in mind, that there was a real relief rally there in place that we have seen operating, and you can see itself how it's bumped, and we've actually jumped above those highs. If I'd see closing above that would be very bullish for Europe in general. You can see there, how we just we had talked about the gap. So we closed here on Friday. opened up on Sunday, big gap, all right, and then not only was there a big gap, but actually prices sailed away north as well. So it's been quite quite a strong move there we've seen over the last couple of days. Okay, once again, it's shows you how much the index is correlated. We've had a nice up move with a nice bullish flag formation there showing up. Quick minute or two on let's have a little look at oil, shall we? Okay, so here we go. Oil's been a bit of a strange beast, all right. So just going to pull my chart in there, 52. So up until last year we were looking just banging ahead against 50, and then this year for a good while we were just bouncing back and forth between basically 52 and 55. Okay, we're in a touch. We've fallen down. We've climbed back up. We're falling down again. It's a little bit of a strange story at the moment, oil, in that sense. So at the moment, I'm looking at it being sort of like that. We've had effectively lower highs, and I'm wondering to see if we're going to get a lower low in oil as well. If I was, well, then we're looking back down towards the 40 level. Okay, that's what I'd be interested in. Have I got what else have I got here up here? Oh, sorry. We'll have a little look at not the US 100, but actually what we want is, well, in fact, no, we can have a quick look at the US 100. I know we've done here we go. I know we've done the S&P and the Dow. I suppose the thing is, for the Nasdaq is that it's broken to all-time highs. Okay, that's what's happened this week. That's what it's done there, right? And invariably, some of that might be off the thoughts of Trump's doing a repatriation deal. Okay, so he's talking about doing a one-off repatriation. So companies like Apple, etc., are holding money in offshore accounts. If they bring it back to the United States, they'll only get charged tax once off at 10%, and that's the money that Trump thinks he's going to use for infrastructure projects and to build a wall. We shall see about that. But invariably, the Nasdaq has broken to those new highs there. But I did want to have a little look at the FTSE 100, all right. So after Brexit, we had the big inverse head and shoulders, and price ran away nicely up to the 73.50 target we had, but now it's been sort of moving. It's a little bit, as you can see, it's not exactly convincing. And then what we did see was on last Tuesday we saw a huge collapse in the price of FTSE when the snap election was raised. Why was that? Well, markets hate uncertainty, and even though people think May will win, having an election is always an uncertain element. Furthermore, by the people thinking that actually, it would strengthen Theresa May's hand and provide, a better Brexit negotiating position if she were to win and win strongly. That meant it would be good for sterling. So invariably, what we saw was sterling, price raise, which is what we saw there on those other charts. What people forget is the FTSE 100 doesn't really truly reflect the UK economy anymore. In fact, sort of three quarters or so of the constituents of constituents of the FTSE, they actually, make most of their money overseas, and so they are reporting in dollars, and they're taking their profits in other currencies. So when the sterling was very weak, it was effectively giving them a 15% boost in their profits. Now that sterling comes back and price rises, that actually means that the share profits on those companies will diminish. So there you go, ladies and gentlemen. I think we've covered quite a lot there for this evening. I hope that you found that useful. If you have any questions, by all means, just ping them away. Alternatively, don't hesitate to get in touch with your Valutrades account representative, and they will be very pleased to help you and to help you either with understanding the elements we discussed, or actually talking you through using the MetaTrader 4 platform. As always, I wish you the very best of success in your own trading, and I look forward to speaking to you soon. Many thanks.